Something called the MOVE Index has begun to move higher recently. This index measures the volatility of the bond market, and not only is it sitting at one of the highest levels of the last 20 years, but it's also been flashing a big short-term warning signal for the stock market today. You see, if we flip this MOVE Index around and we add the S&P 500 on top, we observe that the two are very closely correlated to one another. As bond market volatility rises, the US stock market is typically declining, and as bond market volatility falls, the US stock market typically rises. And as you've probably already noticed, we've recently started to see a divergence between what the stock market is doing at all-time highs and bond market volatility heading in the opposite direction. If you've been watching our videos, you'll know that falling bond market volatility is something that has kept us very optimistic on the stock market throughout 2024. We've had some very successful trades throughout this run using dips in this market to initiate new trades. You can see some of them highlighted here, many yielding over 20% returns before we closed them out. Two moments this year where we shifted from short-term optimists to short-term pessimists. In both of these instances, we cut out a portion of our trades in order to prepare for a market correction. Today, we're seeing a very similar setup developing. We already sent out sell alerts to our members, cutting part of our positions out, and I'm going to explain everything to you in this video. Firstly, the stock market is starting to reach extreme greed levels. This is an indicator that has actually been developed by CNN to gauge investor sentiment. In the index, they include things like the put-call ratio, corporate bond spreads, market momentum. Now, all of that may sound very complicated if you're not familiar with these indicators, but essentially they're using a bunch of different metrics to measure how much risk investors are currently taking. And in theory, when we reach extreme greed, that's not such a great sign for the stock market. And currently, that's where we are. When we look at a chart of this fear and greed index over time, you can see the higher readings here are when this indicator is in extreme greed, and the lower readings is when this indicator is in extreme fear. Well, we see that in many instances where this indicator reached extreme greed, it did lead to an important market peak, followed by some kind of a pullback in stocks. But we also have an example in early 2024 where this indicator stayed in extreme greed and the stock market just continued to move higher. So these extreme greed readings do give an indication of when the market is vulnerable to a pullback, but in order for that pullback to actually occur, you need some kind of a catalyst. In April of 2024, in October of 2023, and in August of 2022, you all had a catalyst that took the market down. And believe it or not, we're seeing the exact same potential catalyst develop today as in those instances. And that is none other than rising government bond yields. This is the 10-year Treasury bond yield, and it's been rising very aggressively recently. This is an extremely important driving factor of financial markets, the yield that you receive in exchange for owning US government debt. Depending on what the 10-year Treasury yield does, the stock market will reprice itself. For instance, if the 10-year Treasury yield were to jump from 3% to 4% very quickly, all of a sudden it becomes a lot more attractive to own US debt. And that leads many investors to rebalance their portfolio, reducing their allocation to stocks and increasing their allocation to bonds because they're receiving a higher yield. Because of that higher yield, and this dynamic can cause the stock market to correct briefly as you see that rebalancing. Now, that is exactly what we've seen today. The 10-year Treasury yield has jumped from 3.6% now to 4.2%. This is the most rapid increase in bond yield since April of 2024, and before that, October of 2023, and before that, August of 2022. All moments where the stock market saw, at the very least, a correction. So with interest rates spiking and bond market volatility spiking, with the stock market at all-time highs and in extreme greed zone, we are shifting our outlook on stocks to a more cautious stance in the short term until we see evidence of this resolving itself. This is a price channel that we're closely looking at on the S&P 500, and we believe this spike in yields could catalyze a correction down towards the bottom of this channel, potentially taking the S&P 500 down to 5,650 points. Now, I want to be clear, we don't have a crystal ball. Anybody that tells you they can predict the stock market's next short-term move flawlessly is either a fool or a liar. So no, we're not going leveraged short on the stock market based on this information, because we could be completely wrong about it. I'm going to share with you exactly what our allocation strategy is with our clients in just a minute. But first, let me explain why we don't believe this is going to catalyze a much larger market correction like we saw in 2022. This is what government bond yields were doing in 2022. They jumped from 1.4% to 4.2% in under a year. As you can imagine, this caused a significant repricing of the stock market as this was happening. The S&P 500 dropped 25% from peak to trough. So for a 20% plus correction to occur on the stock market today, you either need an economic recession to occur in the US, which we think is a possibility a few months from now, or you need bond yields to spike up significantly higher like they did in 2022. But we don't believe this is very likely. And the reason for that is explained on this chart. This is an index that we built to reflect commodity markets. It includes things like the price of wheat, cotton, soybeans, nickel, copper. It gives an indication of what the price of raw materials of the economy are doing as a whole. And as you can see, they've recently been going down. And that is extremely important for what bond yields do next. If the price of wheat is going up significantly, that's going to translate into higher bread and pasta prices. If the price of oil goes up, transportation becomes more expensive. If cotton goes up, clothes become more expensive. This is what's called inflation. And raw materials, also known as commodities, have a massive impact on inflation, which itself has a massive impact on government bond yields. This is why when we plot our chart of bond yields on top of our basket of commodities, we see that the price of commodities actually leads bond yields by around 6 months. Not at all, so currently suggesting that bond yields should be heading lower, not higher. The reason this works is because bond yields often trade based on what the Federal Reserve is doing. Because after all, the Federal Reserve is the most powerful institution in the world. And to make their decision, the Federal Reserve uses official government data as their main tool. They don't look at the price of commodities, even though those are ultimately the best leading indicator of inflation. So by using commodity markets instead of government data, we can have some foresight regarding what interest rates are going to do next. And currently, commodities are not at all doing the same thing that they were doing in 2022. Back here, commodity markets were telling us that inflation was going to pick up significantly and that bond yields were going to begin rising significantly as a result. Today, it's suggesting that bond yields are going to continue trending lower here, which could have a positive impact for the market as long as there's no economic recession in the US, meaning that stock market earnings can continue to climb. And right now, stock market earnings are very much climbing. These are S&P 500 forward earnings, so analyst estimates, and they've been steadily climbing higher even over the last few weeks. So in other words, S&P 500 companies are making more and more money, which can be a massive upwards force for stocks, especially if interest rates do stabilize. So believe it or not, if the stock market does correct here, we'll be looking to buy the dip, just like we did in April and August of this year. We closed a few of our trades earlier this week in preparation for a pullback, but we generally remain net long on the market. For instance, we still have an active trade on silver that you see here that is extremely correlated to the stock market. We initiated this trade on silver back in August, and it's currently up about 30%. Did it correct a little bit with the stock market? Absolutely, but we still remain extremely constructive on silver. So our message to our clients recently hasn't been one of panic selling, but more one of getting a bit more cautious on stocks, putting some cash on the side because we could have a buy opportunity on stocks come soon. We already have a list of stocks that we're closely watching to buy the dip on. If you want to have access to all of our trades and the details of our strategy on the stock market, make sure to sign up to our website.